So far, it looks like the US has more cards in the trade war with China, and China, on the other hand, seems to have more cards than the US. But in actuality, either the US or China can actually truly win this trade war. The idea of winning a trade war between China and the United States is tricky, as both economies are deeply interconnected, and trade wars tend to produce mutual harm rather than clear victors. Let's break it down based on available evidence and reasoning. China's strengths in a trade war. 1. Export controls and supply chains. China has significant leverage due to its dominance in critical supply chains, particularly for rare earth minerals, semiconductors, and pharmaceuticals. For example, it controls a large share of global rare earth production, which is vital for U.S. industries like tech and defense. Restricting these exports could disrupt U.S. manufacturing. 2. Economic resilience. China's economy, despite recent slowdowns, e.g., real estate issues and capital flight, has adapted to external pressures. Its large domestic market and state-driven fiscal stimulus provide a buffer against tariff impacts. Beijing's ability to absorb economic shocks is enhanced by its centralized control, which can prioritize long-term goals over short-term pain. 3. Geopolitical opportunities. Tariffs from the U.S. have pushed China to strengthen trade ties with other regions like the EU, Japan, South Korea, and Southeast Asia. For instance, China hosted an economic dialogue with Japan and South Korea in March 2025, aiming for a trilateral free trade agreement. This diversification reduces reliance on the U.S. market. 4. Political advantage. President Xi Jinping can use U.S. tariffs to rally domestic support, blaming economic woes on American aggression. This never-again mentality, rooted in historical grievances, helps unify the population and deflect criticism from internal issues. China's vulnerabilities. 1. Export-dependent economy. China's economy relies heavily on exports, with a global trade surplus of around $1 trillion in 2024. The U.S. is a major market, and tariffs of 125% or higher, as imposed in April 2025, could severely disrupt coastal manufacturers producing consumer goods like clothing and electronics. 2. Economic slowdown. China's GDP growth is under pressure, with forecasts cut to 4% for 2025 by Goldman Sachs, below the 5% target. High